Hi, so I'll start, I guess. My name is Dan Mayo. I'm a principal at Withum, Smith and Brown, and I'm a tax lawyer by day and PPP aficionado by day as well. And so ever since the CARES Act came into was enacted in March 27th, I've been spending the bulk of my time on PPP EIDL related issues, and I'm happy to be here today with Anthony Rainone, who will introduce himself as well.
Hi, everybody. Good afternoon. Anthony Rainone from Brach, Eichler. Happy to be here today. And yes, Dan and I are the two most exciting guys at a cocktail party these days because we can answer all your PPP questions. So let's not bore you with any more bio. Let's jump right into it with the first polling question. If everyone could click that so we have your answer, it'll sum them up for us.
Yep. So have you applied for your PPP loan?
Okay. Look, 80 plus people have applied. Only a very small handful have not. All right, good to know. Let's, I think Dan's going to take it away from here.
All right, people are still voting for a couple more seconds, then I will close it out. Okay, and here are the results.
Great, so 83% said they have applied, 9% no, and 9% NA. Great, okay, so let's start with the presentation. There's been a lot of guidance issued on the PPP, as you can see here. Since the CARES Act was enacted, there have been 3 statutes and a tremendous amount of SBA guidance. The interim final rule came out on, so this presentation sort of talks about stuff that's come out since the PPP Flexibility Act, which we'll talk about. You have the plenty of these IFRs are interim final rules, which are regulations that are published by the SBA in consultation with Treasury. They've also, there was a PPP loan forgiveness application that came out in May. That's been changed, and so there's a new one now as of June 16th, and there's also this EZ application form, which is intended to simplify the process. We'll talk a little bit later about possibly getting rid of the applications for some subset of borrowers altogether. Then there's been some additional IFRs, and then the PPP Extension Act, which again we'll talk about as well. So we can go to the next slide, please. So the PPP Flexibility Act was enacted on June 5th, and the most important thing it did was it extended the covered period from 8 weeks to 24 weeks. And what this does is it virtually guarantees that almost everyone will obtain full forgiveness of their PPP loan amount. And so if your loan was issued before June 5th, which was the date it was enacted, you default to a 24-week period, but you can elect an 8-week period. For loans on or after June 5th, there's no 8-week option. It assumes that you want the 24-week period. And so when you think about the loan, the PPP loan was based on 2.5 months of compensation, right? Approximately 10 weeks. Now you can use a 24-week period to determine forgiveness. So even if there are some headcount or wage reductions, most borrowers will obtain full forgiveness, as we'll see later on. The only borrowers who will not obtain full loan forgiveness are those who have severe headcount or wage reductions. And when I say severe, I mean in the order of more than 50%. That's just a rough guide. It's not a hard threshold. The cuts need to be greater than that. But we can talk about that as we work through the slides. Also, this rehire rule. The date was extended. It used to be June 30th, but the rehire rule was extended to the end of the year. So FTE and wage reductions, FTE meaning full-time equivalent, which is really the headcount reduction rule, and wage reductions can be eliminated or cured if they're fixed before the end of the year. They won't be counted as a negative in the forgiveness calculation. So we'll turn to the next slide, please. The maturity date for loans has changed, right? You recall the statute had a 10-year maturity date. The SBA then modified it to make it a 2-year maturity date. So everyone on this call probably has a loan with a 2-year maturity date. For loans after June 5th, they're going to have a 5-year maturity date. Again, we'll see in a moment, this is largely irrelevant. If your loan was issued before June 5th, which is probably most of the people on this call, You're permitted to negotiate with your lender to extend the term, but it's really not necessary, because if you're expecting full loan forgiveness, whether you have to repay the balance in 2 years or 5 years really is not important, since you don't expect to repay anything. And again, most borrowers should obtain full loan forgiveness. If you're not, we expect you'd have this major headcount or wage reductions, and certainly you should be speaking to your advisor, whoever that is, if you don't think you're getting full forgiveness, to see why that is, and if you can do something about it, by possibly with the rehire rule or other things we'll talk about, either the safe harbors or the exceptions we'll talk about in a moment to the headcount and wage reduction rule. Also, on the payment deferral period has been extended, so that it used to be it was extended until 6 months. It was a 6-month payment deferral period. Now it's if you apply for loan forgiveness, you don't have to pay anything until you get a decision on your loan forgiveness application. If you don't apply at all for loan forgiveness, which is probably a subset of the 5 million loans that are submitted, it's probably a subset of under 10 people who won't apply for loan forgiveness, and it's probably through inadvertence. But if you don't apply, your payment obligation will begin 10 months after the end of your covered period. So if you're using a 24-week covered period, you're looking at 16 months approximately when you have to start repaying the loan. So the next slide, please. So the PPP Flexibility Act, again, brought in these 2 new FTE reduction safe harbors, and that's in addition to the 4 exceptions. So we have a slide coming up in this presentation where we'll go through all of the ways you can reduce or eliminate the effect of any headcount or wage reductions. But the 2 new ones that came in, these 2 new safe harbors, are employee availability and business activity. The first one is employee availability. So the borrower, if the borrower can eliminate reductions, if it can document an inability during the covered period to rehire people who were employees on February 15th, and they were unable to hire similarly qualified employees for unfilled positions. This is an important exception, but I think the next one is what most people will be relying upon, this business activity one, and it deals with if the borrower can document an inability during the covered period to return to the same level of business activity before February 15th, right before COVID really hit. Due to compliance with either CDC, OSHA, Health Human Services, any kind of maintenance of standards relating to sanitation, social distancing, or worker or customer safety. And there was some problem here because a lot of these rules are state rules, and they're not, right, they're based on the federal rules. So the SBA has favorably stated that the inability must be directly or indirectly related to the federal rules, and that's recognizing that the state orders, the shutdown orders, social distancing, et cetera, are based on the federal guidelines. And so, but there are some documentation rules which are required in order to comply with this business activity safe harbor. The next thing that it did was, again, favorably eliminated the 75-25 rule and made it a 60-40 rule. So when you look at the CARES Act, it talks about, right, the whole premise of the legislation was if businesses borrow money and they pay their employees during the covered period, they will receive loan forgiveness from the federal government. And sort of this was to keep employees off of the unemployment rolls. And the way they incentivized businesses to take advantage of this program was the government, in effect, paid the businesses to administer the program for them. And the way they did that was they said you can include some of your overhead expenses, meaning your interest on your mortgage, rent, certain rent and utility expenses of the borrower can be forgiven if they participate in the program. And that was sort of the way to think about it, is the compensation to the businesses for participating in the program. When the SBA got hold of the program, they put in this 75-25 rule and said that only at least 75% of the expenses must be payroll expenses for employees, and that only 25% can be these overhead expenses of the employer. And so trying to limit it to make sure employers actually pay their employees rather than using the money for their own personal overhead expenses. And so there was some uncertainty about whether there was a cliff effect or not, but in any event, this Flexibility Act eliminated that 75-25 rule, made it a 60-40 rule, so more favorable to the borrower. because now up to 40% of the loan amount can be spent on these overhead expenses. And so at least, which means at least 60% must be spent on payroll costs. And they also, the new application that came out makes it clear that it's not a cliff effect. That meaning, if you don't spend 60% on payroll costs, you get no forgiveness. That's not the rule. The rule is that of the forgiveness amount you do, if you have a $100 loan and you get $80 of loan forgiveness, 60% of that $80 must be for payroll costs. So it will reduce the loan forgiveness amount to make sure that the bulk, at least 60% of the money is spent on payroll costs as opposed to the borrower's own overhead expenses, again, which we refer to as the interest on the mortgage, the covered rent, and the covered utilities. Next slide, please. Then on July 3rd, this is the PPP Extension Act. This is the third piece of legislation after the CARES Act that modified the PPP program. It extended the loan application deadline for 5 weeks, so now borrowers can apply until August 8th. They can get a PPP loan. And the reason they did this was there was significant funding. 130 billion remained in the PPP program. And so they had, if you recall, that the first round of funding was approximately 300 billion. That was used up pretty fast. There was a flood of applications, and the money was used up quickly. Congress reauthorized approximately another 300 billion. And as you see here, 130 billion of that second round of funding remained in the program. So they extended the time period, thinking that perhaps some people just didn't have a opportunity to apply yet, weren't aware of the availability of the PPP program, et cetera. So you do have until August 8th to get in on the PPP program. Go to the next slide, please.
Okay, we're on to our second polling question. Have you obtained a PPP loan?
As expected, there's a high percentage of yeses, or they wouldn't be on this webinar.
About 10 more seconds to put your vote in. Okay, I will close it out, and here are the results.
So we have 83% said yes, 6% said no, and 10% said NA.
Well, I'll say for the people who have not applied or not obtained, which there was a small percent, I'm guessing you're, deciding whether to apply for one by the new deadline. So I don't know what Dan's opinion is, but I'd say go for it. It's not too good to be true. It's a workable program, and if you need the cash flow, that's what it's there for. So why don't we go on with it?
Anthony, I agree with that.
You agree with that? Yeah,
I
as
agree.
Dan and I were talking before the seminar, you all are, business, you run a business, you pay your taxes. This program is here to keep you guys able to pay your employees and pay your overhead. So I don't think you should have any intellectual objections to the program. So let's talk about the loan forgiveness. You remember the original program was 8 weeks. You had to spend the money. And what happened was, people rightfully said, I can't spend all the money you gave me in 8 weeks. And that was a factor of the original 75-25 rule, where they said you could only spend 25% of this stuff on overhead. That was not in the statute. It wasn't even in the regulations. It was just guidance. And so this was, the 24 weeks came out of that. They did not want money returned. They didn't want businesses being saddled with loans that were intended to be forgiven. And so now you have your 24 weeks. And so to date, since this happened, I have not run into a client who said they have a hard time spending the money at this point. In fact, most of my clients have spent it all, and they're looking forward to the forgiveness process. Dan had mentioned that, yes, now you have, if you got your loan before June 5, you could still go on the 8-week period. And they put in something called the alternative payroll covered period. And that was, many clients called up and said, wait a minute, Anthony, my payroll doesn't line up with this 8-week or 24-week period. So what they said was, listen, if you pay at least biweekly, so if you pay weekly or you pay biweekly, you can actually elect to start your 24-week period to spend the money on your first payroll date. And that was, I think, important for most people just to keep sane about the whole thing and not have to worry about figuring out which days of a payroll period were covered and which were not. And so they give you the example in the regulation that if you got your loan on April 20th, but your first day of your pay period is April 26th, you can actually start to count your either 8 weeks or 24 weeks on April 26th, and you count it out from there. And one thing to mention to everyone, I've seen this mistake multiple times on clients of mine that have sent me their forgiveness applications. You count the 8 weeks or 24 weeks, you include the day you got the loan. I know in virtually every other context, you start on the day after, but in this program, the regs are clear. You do count the day you got the loan towards your 8 or 24 week period. Let's go to the next slide. And so a quick review, I think you guys know this stuff, but starting first with our non-owner employees. So that's what it is, anybody that doesn't own the place. Originally, they had a cap of 8 weeks. That was $15,385 in cash compensation. And now with the 24-week max, it can go as high as $46,154. And Dan and his colleagues were nice enough to put how we did that math. You just take the 100,000 and you annualize it on a weekly basis. The regs did clear up. A big question in the beginning was, Anthony, can I pay my employees a bonus with this money, or hazard pay, or what some of my clients called battle pay? And I think that's very appropriate for the healthcare industry. Most or all of you are on the front lines, and I think it's appropriately called hazard pay or battle pay. So yes, you can include that towards the employee's max of either $15,385 or the $46,154 if you're doing the 24 weeks. Also for the non-owner employees, this was some confusion. The non-cash comp, that's the healthcare, the retirement benefits, the state and local unemployment taxes. That's in addition to those two numbers above. So in addition to the 46 or 15,000 cap, you can include all these other employee expenses. So it's a nice, helpful program. It's doing what it's supposed to. Then we turn to our owner employees, and there's many categories of owner employees, and they have the similar $15,385 limit on the 8-week plan. And for the 24-week plan, however, the cap for them is $20,833. Some called me up and said, wait a minute, why can't I do the 46? Why can't you do the 46? Because the regulations say you can't. That's, in a nutshell, that's why. So when you look at the last 4 bullets, this is every conceivable category of owner. You've got C Corps, you've got S Corps, you have your Schedule C filers, and you have your general partners. And there's little differences between each of them, not the least of which, if you look at the S Corp, Schedule C, and general partners, you cannot, and I repeat, not include the healthcare contributions for them. Or I'm sorry, those are included within their cap. So unlike the non-owner employees where healthcare is in addition to the payroll cap, the exact opposite is true for those last 3 bullets there on the slide. And so let's go on to the next slide. And for the non-payroll costs, there really wasn't much controversy or puzzling on these. The statute was pretty clear. Unfortunately, the regulations did not muck up the waters on it. It's any interest on mortgage obligations on real or personal property that was incurred before February 15. You also have any rent on a lease that was incurred before February 15. And then finally, the utilities, any utility accounts you had in place before February 15, that's your electric, gas, water, transportation, telephone, and internet. I did have some clients trying to be cute. They said, well, telephone, we have all this extra money, when they thought it was only 8 weeks to spend, and they thought they would buy the staff new cell phones or upgrade their cell phones. And we advised against it, and the regulations have confirmed not to do things like that. So I hope none of you have tried to do that. Let's go on to the next slide. So the more recent regulations did clear up this. Anthony, what exact expenses can I include here? Because sometimes you get a bill that, before the covered period, but you pay it during the covered period. Or you get a bill during the covered period that you pay after the covered period. So they did interpret this as pretty broad and pretty favorable to the businesses. And so on payroll, they consider payroll that is eligible any pay that was earned by the employee during the covered period or paid to the employee during the covered period. So you had some clients, when they started their covered period, maybe their first payroll day included time from before the covered period. Well, the reg said you could include that in the forgivable amounts. And then more importantly, many of you will end your covered period, but the payday will not be till, say, a week later. You can include that payroll in the payroll cost also. So that was a good help to the businesses. And then last but not least here, I think it was a little self-explanatory, your forgiveness amount can't exceed the principal amount of the loan and any accrued interest. So not much controversy here, but fortunately, the regulators, I think, interpreted this part of the statute in a sensible way for the employers. So let's go on to the next slide. I think we're up to a polling. Excuse me, Dan's going to take over from here.
Great. So now we're going to talk about ways to eliminate an FTE reduction. And so there's three sort of big broad strokes here on how to eliminate any FTE or headcount reductions. So one is the rehire rule, which is in the statute itself as modified to that 12/31 date. Then we have safe harbors and exceptions. And so the purpose of this slide is just to try and help keep it straight. So the rehire rule talks about reductions from February 15th to April 26th. And so this is if you had reductions in that period and you eliminated them by the end of the year now, it used to be June 30th. If you eliminate them by the end of the year, you can disregard any and all, if it's a headcount reduction, let's say you get a strange outcome here. Let's say you had your reference period had 100 people and your covered period had 20 people, right? You have a huge reduction. But the way the rehire rule is written, if one person left between February 25th and April 26th, and you rehire that one person, you can disregard the entire 80 person headcount reduction. And so it's a very quirky rule, that rehire rule. So that's out there. That hasn't changed other than that 12/31 date is now it's been expanded to 12/31, extended to 12/31. Two of these two FTE safe harbors. This came in the new legislation. We talked about that in the earlier slides, so I won't focus on them here. And the last are these 4 FTE exceptions, which the SBA has announced. The employees' hours were reduced because they refused an offer at the same salary or wage to restore the reduction in hours. This is the example of the employees making more on unemployment than they were at the job, so they don't want to come back. So they refused the offer. Then you have employees that are fired for cause, they voluntarily resign, requested a reduction in hours. So someone voluntarily retires, or sometimes you get questions, like you get some difficult questions. Someone says, I have an employee that is going on, they're in the military and they're going to, they're a reservist, they're going to the reserve, so they have to leave. And so I think, it's not clear, but what we said was, well, that sounds like someone who's voluntarily leaving, right? They were requesting a reduction of their hours because they chose to join the reserves. They weren't, the draft is not in effect, at least as far as we know. So that was that can be considered the employee's voluntary action. And so when you get a lot of these factual scenarios, it's a matter of trying to fit them in one of these buckets. So see if you can eliminate the FTE reduction. But again, as we go to the 24-week covered period, a lot of this stuff falls away, because if you have 10 or 20% headcount reductions, not likely to affect your forgiveness. I guess it could, based on if they were high earners and everyone else is an extremely low earner. But in general, you need severe reductions to affect the 100% loan forgiveness. Turn to the next slide, please. So some additional points on this. I won't spend too much time on this. We want to leave time for questions, but I'll focus on that. The second bullet there, that in blue, the gross spending is a starting point for the loan forgiveness calc, which is why borrowers will obtain 100% loan forgiveness. So if you had your loan amount was based on 10 weeks, but when you do the forgiveness calculation, you get to start with 24 weeks of spending. And so just, if you just do that right off the bat, you realize you're going to exceed, the forgiveness amount will exceed the loan amount. And because forgiveness is limited to the loan amount, you'll receive 100% forgiveness. And so I like to do a quick example I'll try and keep the math very simple for people, just to illustrate the point. So let's say, if you think of the 24-week period, there's 3 blocks of 8 weeks, right? You have that initial 8-week period, and then 2 more blocks of 8 weeks. So call them block 1, 2, and 3. Now let's say after the 8 weeks, there's 100% employment for 8 weeks, and then they cut the headcount, they reduce the headcount 50%, and they maintain that 50% reduction in block 2 and 3. So you have a borrower with a $100 loan, and so normally they would be expected to spend $100 in that first 8 weeks. And so you have $100 full employment in that first 8 weeks, and then you have 50% employment in the second block and 50% in the third block. And so you've spent 100, 50, and 50, right? So you spent 200. And so what's the reduction? The reduction, FTE calculation, takes a weekly average. So when you take the average of 100, 50, and 50, it comes out to around 66%, which means you had a 1/3 reduction in your headcount. Because you had 100%, 50%, 50%, it averages to a 1/3 reduction. Well, your gross starting point is gross spending is your starting point in the calculation. Well, this, in the example, the person spent $200. Even if you reduce that by 1/3, right? You take off, call it 60 to keep the math simple, you're still at $140 of spending, which gives rise to 100% loan forgiveness. So you see how cutting 50%, in the block 2 and 3 in weeks 9 to 24 did not affect full loan forgiveness. And that's sort of a quick example to really help drive home the point that you need severe reductions in headcount or wages to impact that full loan forgiveness. Next slide, please. Okay, so this is the borrowers. The SBA has announced that borrowers can submit their loan forgiveness application at any time. And I know we got a question on this. I saw it come through. We will, by the way, allot some time at the end to go through the questions that have been raised. But the SBA has said you can submit the application at any time, even before the end of your covered period. So if you have a 24-week covered period, you can apply after week 10 if you spend all the PPP money after week 10. The only condition the SBA has put on it, they said that the borrower must account for any wage reductions in excess of 20% through the end of the covered period. So if at the end of week 10 you have wage reductions in excess of 25%, you have to extrapolate and account for that through the end of the covered period. But they didn't say anything about headcount reductions. So it seems like if take an extreme example, which does not address, and we're not advocating for this, but I'd like to point out extreme just to illustrate the point. You spend your money at the end of week 10, you apply for loan forgiveness, the next day you fire everybody. Well, the SBA hasn't said you have to take that into account, which is it's an odd statement, in that they didn't account for this headcount reductions. And the other point I want to make about this is the SBA allows you to apply, borrowers to apply before the end of their covered period. So they can apply at the end of week 10 for a 24-week covered period. But as a practical matter, banks are not, and lenders are not accepting applications yet. So I think the real limiting factor will not be this rule. It will be the lender's willingness to accept the application, one. And then two, the lender has to make decisions about what they do on this rule about wage reductions in excess of 25%, and also that headcount reduction rule. And so the lenders may be uncomfortable accepting applications early because they don't want to risk making a mistake and being on the hook for loan forgiveness amount. And so I think that may be a limiting factor too, is the reticence of lenders to accept them early, just because the rules are not crystal clear, and they may not perceive them as giving them the same level of comfort they would have if they waited the end of the 24-week period. So that may be a constricting factor. Next point here is the forgiveness amount, the tax-free nature of it. And so this led to a lot of confusion. And so the way the program works, and I will make a plug for an article that I wrote. I wrote an article on the taxation of PPP loans and loan forgiveness. It was published in the Daily Tax Report, which is a tax publication for tax lawyers and tax professionals. But it's also, we posted it on the Withum website. So it walks through what we're going to talk about now, and sort of all the tax aspects that you might want to think about in connection with a PPP loan. So the amount forgiven, we borrow $100 and that amount is forgiven. In the absence of anything special, debt forgiveness is a taxable event. So when you take out the loan, there's no tax consequence. But if that loan is forgiven, you then have income. You have income of $100. And that's what happened here. The Congress said in the CARES Act that the amount of loan forgiveness is tax-free. However, we think it was probably an oversight. They never addressed what happened on the expense side. And when the IRS was asked the question, how do you account for the taxation of PPP loans, they issued this notice 2020-32. And I put a link here, so if you download this slide deck and you can click on that, it'll link it right to that notice. And so what that notice says is, even though the cancellation of debt income is tax-free, the expenses that gave rise to that cancellation of debt income, those are not deductible. And that's not a controversial ruling from the IRS. And they applied sort of conventional tax principles to reach that totally legitimate conclusion. People who criticize this, I don't think, are faulting the IRS. I think they're saying Congress made a mistake here. And they should have been clearer with what they intended in the statute. Many legislators have said they intended this to be tax-free. They didn't intend these expense disallowance, but and that's probably true. They probably intended that, but until they change the legislation and issue new legislation saying that it's tax-free, the way it works now is the amount forgiven is tax-free and you lose the deductions, which means the effect of which means the loan forgiveness amount is taxable, right? So you have a $100 loan, you don't pay tax on it, but you lose expense, you lose 100 of expenses, which means your taxable income goes up. So unfortunately, as of now, the effect of this is tax. If you receive a $10 million loan, you will pay tax effectively pay tax on that $10 million. Now, there's a lot of talk about fixing this, and Congress may fix it. However, when you look at the Republican version of their bill that was proposed yesterday, I don't believe there was anything in it addressing this. And one of the when the Democrats came out and said, there's bipartisan support on this to fix this issue, but it's odd that it wasn't included in the Republican proposal. So I think that there's a good chance that this issue is fixed, and that they won't, I don't think they will, I think they'll make it clear that you don't lose the deduction. So they will hopefully legislatively overturn this notice 2020-32. Next point I want to make here on this slide is that the SBA and Treasury have released information. There was talk about, naming and shaming. And so these large companies that took out PPP loans, eventually their names would be revealed, and the public would, become irate that they took out these loans. That happened. A lot of money was returned. We know that. That's that famous FAQ 31 that came out saying that the borrowers didn't meet that certification, that the loan was necessary to support their ongoing operations. But now the SBA has actually released the names. You can download it in a Excel spreadsheet, which makes it searchable. And so if your loan is over 150,000, the borrowers are bucketed, and they will provide your name, address, the zip code, the type of business you're in, your NAICS code. They will provide that information, but they bucket the amount of the loan, so people won't, the public will not know the exact amount of your loan. But as you can see here, the bands are pretty tight. So if it's 150 to 350,000, 350 to $1 million, and the bands get bigger, and the 5 to 10 million is the high end of the range. So they thought that was somewhat confidential information, because if you know the amount of someone's loan, it tells you their payroll, essentially, right? Divided, it's 2.5 months, so they can figure out your payroll. For smaller loans, under 150,000, only aggregated loan data will be released. They won't release the names. But again, there is talk of changing this, and there are some people who want this information released, so that may come out in the future. But as of now, it has not been released. Next slide, please. Polling question
on to
number
our
3.
third polling question. What is the amount of your PPP loan? All right, 15 more seconds. All right, I'm going to close it out, and here are the results.
I don't know if you can see them on the screen, but 43% of the loans are between 0 and $500,000, 16% are between $500,000 and $1 million, and 23% are between $1 million and $5 million. No one on the phone has a loan in excess, on the webinar, I should say, has a loan in excess of $5 million. Great.
Okay. All right, so let's turn the loan repayment, and really, this is what happens after you submit the application, because that's what everyone's been asking. What happens next? Well, once the banks have told you, okay, we'll take your application, you'll submit it. The lender, and this was in the statute, I believe, they have 60 days from receipt of the completed application to give you a decision. And the SBA ultimately also tells the lender whether or not, it's going to happen. So that's your general window. Now, they could approve the whole thing for forgiveness or in part only. They could deny the whole thing. They can also deny forgiveness if, let's say, the documents you sent them were insufficient, right? Maybe you left out a payroll report. Maybe you forgot one of the quarterly returns that you should have included. So some of you may very well find yourself getting a denial without prejudice, as they call it. Don't panic if you do, because that's probably just, you need to provide them some extra documents. So please don't panic if you get a denial without prejudice. And there will be more guidance out there. And these are the guidance we have so far, and that's on this slide. This is really the under $2 million loans. Because if you remember, the SBA in their quote guidance, they said, look, we're going to personally review all loans over $2 million. Because after all the hullabaloo of, the Los Angeles Lakers taking money and things of that nature, there's a little bit of a PR blunder to allow that to happen. So they basically said, look, we are going to audit any loans over $2 million, and there's going to be separate guidance on that. You'll have no payments due until the decision is made. And if they decide not to forgive some of your loan, that's when your payment will start then. And that's really it. Let's go to the next slide. You're saying, what do we have to submit with it? Well, we mentioned there's a couple forms out there right now. There's the General Loan Forgiveness app, and there's what they call the EZ application form. I did get a call from a client last night, and she alerted me to something that I did see. One of the forms now does have a mathematical error in it, and it's one of the problems that's going on right now. So the SBA and the banks are all working. The banks appear to all be developing their own forms, that they're not going to rely on just the form that the SBA used. So that's part of the delay, that, the banks, they have to create a process that can be scaled so that first pass can be handled by computer and, entry-level people that can check the boxes. So that's what's going on. They're getting those systems in place. But on payroll costs, it's going to be pretty straightforward. I'd say I'd be shocked if anyone on this phone does not use a third-party payroll service provider. So for those that do, you're going to just generate a payroll report for the covered period. For those that don't use a third-party payroll provider, you'll have to generate your own report and showing what you paid to each employee over that covered period. On the EZ form, you actually don't need to itemize each employee, but you will need to retain that information in case the government asks for it. In addition, because part of the forgivable costs are the local and state payroll taxes, unemployment, disability, you will have to provide your quarterly, I think it's called a WR30. Dan, correct me if I'm wrong on that one. That's the state of New Jersey form, and the IRS form 941, that's your quarterly filing. And that links both your number of employees as well as did you pay the right payroll tax contributions in there. So you're going to need to either maintain or provide those forms depending on whether you use the EZ form or the full form. And then on the other items, so health insurance and the retirement plan payments, pretty simple. You'll have a copy of the statement for that account and a copy of the payment. If you did a wire transfer, print proof of the wire transfer. If you wrote a check, keep a copy of the canceled check. So anybody here on this line, this should not be a heavy lift to put together and maintain. On the FTE item, another documentation requirement, because remember, part of the forgiveness process is substantiating the number of FTEs during the covered period on a monthly basis. Now, that's going to be supported largely by your payroll filings that we just talked about. So, I don't think this is a complex process on the documentation. Let's go on to some other documentation requirements. Next slide. So on the non-payroll items, again, whether it's your mortgage, your rent, your lease, your utilities, you get a statement every month. You keep a copy of that statement and a copy of the payment. And that's really it on these. There's no more magic to it than that. And what I would say is make sure you keep and provide to them proof that that account was in effect before February 15. So you're going to want your January and February invoices, even though it's not in your covered period, just to substantiate that either the lease, the mortgage, or the utility bill was in effect before February 15, 2020. Let's go to the next slide. On this last one, we've got this is items that you must maintain for 6 years. And you see the big red 6 years there? It's a very good emphasis because it's going to happen to some people on this line. 4 or 5 years from now, you're going to get a notice or a request saying, please give us the following documentation. And you're going to say, if you're not organized, well, wait a minute, I don't have that. Well, here's the copy of what I submitted to the lender. But as you will see with the EZ application, you don't necessarily have to submit the documents to the lender, but you do have the obligation to maintain them. Now, payroll records shouldn't be a big deal because I'm sure you're all aware, under New Jersey and federal law, you have to maintain your payroll records for 6 years anyway. So anybody on this line who doesn't do that already, put that on your to-do list to make sure you're maintaining them for 6 years. Your tax records, you should have them for at least that long. And your leases and your mortgage payments and your utility payments. On a mortgage, most of you have mortgages of far more than 6 years. So that you should have. On your leases, many of you have leases far more than a 6-year period. So again, just make yourself a nice electronic file with bookmarks in it of both what you submitted to the bank and then another one with the additional documentation that we've given you here, so that, hey, 5, 6 years from now, you literally just pull up PPP documentation and a nice bookmark tab comes up in that PDF, and anything that lender or the SBA is asking you for, you can hand it to them pretty easily. You don't want to be on the receiving end of any enforcement actions under this program. So let's go to the next slide. I think Dan's going to take it over from here.
Great. So now we're going to talk about some things that are on the horizon, what's likely to happen. Definitely will be more changes to the PPP. And, the Republicans released their proposal Monday, at least a summary of it. We're starting to see language filter out in the popular press now. What we think is going to happen is there will be an even simpler application form than the EZ form. There may be some sort of automatic approval process for loans under 150,000. It's not clear whether they will make that 150,000, 350,000, or even 2 million. But what they're contemplating is a one-page certification that is, you made a good faith attempt to comply with the eligibility and loan forgiveness provisions, and that would be it. And you would hold documentation and submit it only if requested, meaning you were subject to some sort of random audit by the SBA. So that is likely to happen, and that's one of the reasons why we are also advising clients, hold off, there's no rush. This is not like the loan application process where they might run out of money. You will get loan forgiveness if you're entitled to it, regardless if everybody else gets it as well. So there's no urgency to apply. The program is changing in mid-course, and all the changes are making it more favorable to borrowers. So absolutely, you should wait. If your loan is under 2 million, you should wait. And even if it's over 2 million, you should probably wait. But if it's under 2 million, you should wait because the process is likely to get simpler. There's going to be another thing, proposals is P4, right? Prioritized Paycheck Protection Program. People colloquially refer to it as P4. There's two competing proposals. I think the Democrats say businesses under 100 employees can get a second PPP loan. The Republicans, I believe, are saying 300 employees and a 50% reduction in revenue. And so they're likely to see a new program come in The contours of it are unclear. Whether who it applies to. It may be targeted to certain industries. That's also being discussed, whether it just covers hotels and restaurants, etc. So they're really trying to narrow this down to smaller businesses and ones that are severely impacted, meaning greater than 50%. I think those are likely to survive the legislative process. Next slide, please. So those other things that are on the horizon, this Main Street lending program is not the topic for today, but we get a lot of questions on this. It is open. Banks are accepting applications. The Treasury website has term sheets. It has tons of documents up there explaining these programs. But the 2 points I want to stress about these. One is the restrictions on operations. So there are compensation, buyback, and dividend restrictions that apply to borrowers. And two, when you look through the program, it's hard to see how the program benefits borrowers other than that it provides the loan. So I think the way to think of this program is that you should go to your lender, and if you need funding, you should try and obtain funding. But I don't think it behooves a borrower to say, I want Main Street lending funding. The program has restrictions, and the benefits don't seem to be significant. The difference between these facilities is minor. So it's not even, other than the size of the loan, it's not clear that there's tremendous difference between the new loan facility, the priority loan facility. But it's open, and I think that the real benefit of this is there's a pool of funds for lenders to enable to lend money to borrowers, and they don't have to keep the risk on their books. The lender can offload the risk to a joint venture operated by the government, so that it will make funds available if funds would not otherwise be available. All things considered, the rate's not particularly fantastic. I think it's in the high threes. A borrower would likely prefer the same loan without the restrictions on compensation, dividends, etc. So just keep that in mind. So with that, I think next slide is questions. Turn to the next slide, please.
Yep, our fourth and final polling question. Do you expect to receive 100% loan forgiveness on your PPP loan? We're about 15 more seconds.
And I'm very glad to see it looks like 79% are saying yes, they expect to get full forgiveness. There's 7% in the no category. Hopefully they're going to speak to an expert in the PPP.
Yeah, I would hate to see anybody paying interest on a loan that's intended to be forgiven.
Right.
All right, now we'll close it out. And here are the results as Dan shared.
Right, so 79% yes, they're expecting full forgiveness, 6% said no, and 15% were on the fence or didn't want to respond, so they put NA. So with that, I guess we'll open it up to questions. We have a lot of questions here. Anthony, do you want to go first? Or?
Yeah, sure. Are we going on video now, or are you guys?
Yeah, sure. Yeah, this way.
Yeah, Dan and I are real. We're here. Yeah, I'll take the first one. And so, a simple question. Somebody asked, essentially, look, I had somebody that retired during the covered period. Do I get dinged on forgiveness? One of the 4 exceptions that was created, which was a good one, was a voluntary resignation, and a retirement would certainly fall into that category. So I would say you don't have to be concerned about that one. Just document the retirement, and I would classify that as a voluntary resignation on the job.
Great. And another question here says, what percentage of ownership for C Corp counts as an owner employee? They haven't defined what that means. So unfortunately, if somebody owns 0.001%, I think you have to treat them as an owner employee, and subject to those additional restrictions. The most important of which is at 20,833, even with a 24-week covered period.
Okay. One of the simpler questions we got, somebody asked here, the bank said we can apply for forgiveness between the 8 and 24 week period, meaning you're not at 24 yet, but you want to apply for forgiveness because you want to get this off your desk. The short answer is yes, you could do that with the proviso about if you've had salary reductions of more than 25%, you're going to have to basically be dinged for that for the rest of the period. So it would behoove you to wait and see what the end of the 24 week period looks like. But if you've had no salary reductions and you've had no FTE reductions and you just want to get it off your plate, there's certainly no issue with applying earlier than the end of the 24 week covered period.
Okay, next question is a very specific one. Are answering services considered a telephone expense? So there's no guidance on this point. I don't believe it would be. If you ask my opinion, I don't believe it would be considered a telephone expense. They're thinking of cell phone, monthly costs of cell phone and landline expense, and a service that helps you service your patients would not likely be included in that.
Yeah, I would agree with Dan. In fact, I'll go further. The telephone expense comes under the title of covered utility payments. So if you have a professional telling you that it is covered, I would get that in writing from him or her. That's
And
right.
I wouldn't listen, even if you got it in writing though.
I wouldn't listen to it then. You're right. I
Yeah.
think Dan's right on that one. I would not listen to that professional. So let's see. We've got somebody asks, is the payroll tax paid on the wages a forgivable expense? Good question. My last night, I believe, Dan, no, it's not the payroll taxes. Well, no, the split was it the employer share is, but the employee share is not. Do you remember this one, Dan?
Employer share of state and taxes is state employment tax, like unemployment insurance, is a payroll cost.
But not the Social Security tax.
Correct.
And Medicare, Medicaid tax, right?
Correct. Next one here is someone says, is there a problem if we just use the PPP loans to pay 100% payroll? No, not a problem at all. So the benefit, the program tried to provide a benefit to borrowers, saying you can include up to 40% of your overhead expenses. You're not required to, so you can use 100% for payroll.
Yep. And then before that this is a good question, about the 24 weeks. They asked about payroll, but does that include 24 weeks of health insurance and pensions? For the non-owner employee, yes, it would. If you look at the definition of payroll costs, it does include those items, and provided it's a non-owner employee, yes, in addition to 24 weeks of payroll, the 24 weeks of health insurance and the pension contribution would be included and forgivable.
Okay, next question here is, what are your thoughts on the U.S. Senate bill that came out Monday, which is the proposed legislation that would allow automatic forgiveness under $150,000 upon filing of a form? My speculation on this, and it is pure speculation, is that there is certain to be a near certain, I'm going to go be very bullish here, that there will be something for people under with loans under 150,000. I think, and I say that because not because I think Congress cares so much about the small businesses. I think the SBA is overburdened. They've issued over 5 billion loans under this PPP program, and if they have to look at each of these loans and look at loan forgiveness applications, it's going to cause the system to explode. So I think 85% of the loans are under 150,000. So I personally think the threshold will be set higher, and that there's likely to be this simplified application, one-page certification for some larger subset of loans. I don't know what that is. The Senate proposal had something for under 2 million. There was a bucket for under 150,000, and then 150 to 2 million. So they are contemplating larger amounts than 150.
Okay, got a bunch more here, so apologize for those looking to jump off of one, but we're gonna answer all the questions. So if hopefully you stick around. So is it their 24-week payroll alone will more than use up my full loan? Do I have to include other costs? So no, this relates back to, I think, a similar question. There's no problem with using the full proceeds for payroll expenses. In fact, I think Congress would love you if you did that, but you can absolutely use it 100% on payroll costs. No problem with that whatsoever.
And the next question deals with hazard pay. The hazard pay is included in payroll costs, just to be clear. They said they didn't catch a recommendation. The recommendation is it's clear. The SBA has made it explicit that hazard and bonus pay both are included in the definition of payroll costs, so therefore are forgivable expenses.
Yeah. And then someone asked, what are the factors to govern whether to file the short or long form, or the easy form, or the regular form? You'll see at the beginning of the easy form, you have to make one of a couple of representations. And last I remember, it was essentially that you had no payroll reductions, no headcount reductions, and there's one other rep in there. As long as you can do one of those, you will be able to use the short form. But that's what it is right now. It's changing, so I would hold on till we get a revised easy form to see exactly what they're going to require.
Next question talks about pension payments during the covered period. The answer is yes. If the pension payments included, it can be included for the 24 weeks, not just the 8 weeks. So the 24-week extension covers all of the items that are included. not just the payroll costs, the cash compensation piece.
And then somebody asked about the health insurance. This is a good one. Are you deducting the full amount of the premium or the premium less what the employee contributed? It's the premium less what the employee contributed. That's what you would take as the forgiveness deduction on there.
Next question here is, how do we evaluate the language in FAQ 31? That's the one that talked about whether the loan was necessary to support the ongoing operations of the business. What is your interpretation how this will be reviewed relative to have access to a letter of credit, a line of credit? So the SBA has said under 2 million, everyone's deemed to meet this rep. So I don't think we had anyone on this call. We had some between 1 and 5. So if you're under 2 million, you automatically meet the rep. You can ignore the FAQ 31. It's not an issue for you. If your loan is in excess of 2 million, you need to consider, the SBA has said your loan will be reviewed for eligibility, which means they will review it for this FAQ 31. You need to consider lines of credit. You need to consider the effect on your business. What I do tell people is it's important to consider not just phase 1 of the virus, but there is a second phase expected in the fall, so that you can consider the longer term impact beyond the first few months. And I think that was expected. The key though, what I don't want to spend, I need to run at 1 o'clock, but the key we're telling people here is you need to assess your good faith at the time you file the loan application. So this is tested as of a moment in time. And so what I've been counseling clients is to document the information you had as of the date you filed your loan application. And so we're preparing memos for clients and helping them prepare it, building the case for this FAQ 31 because expecting an inquiry from the SBA on it. It will be hard to recreate that 6 months from now. So keep in mind it does exist as of the date the loan application was filed. That's the key date you need to prepare and be ready to answer this question.
Another one was, can car payments be included under transportation costs? The regs were not clear. I have not counseled that. I have told people no on car payments. Dan, have you guys been saying something different?
No, we've not been saying something different. Under utility expenses, the only example they've given was gas payments of a leased car, but not the car itself.
Yeah, I don't think you have a straight-faced argument that your car payment will be. We tried. We looked at it early, but I think it's pretty clear at this point you don't.
How long after the 20-week period you have to apply for forgiveness? You have 10 months before you have to start paying, so there's plenty of time. There's no outside date on the loan application for forgiveness. Obviously, the sooner the better after the end of the covered period. You have the information, it's fresh. There's no point in waiting that long, but there is no end date or expiration date so far on the other than having to start repaying the loan.
Okay, someone asked about a voluntary resignation with a higher paid employee, and how do you determine the $100,000 limit if they were only employed for 5 weeks? You take, again, the limit is there. It's 100,000 divided by 52. That's your weekly amount. And it's very simple. If they were paid less than that amount during the covered period, you're okay. If they're paid more than that, then you've got a forgiveness problem for any amounts over the annualized amount.
Next question is this confirming what Anthony said before. Yes, your covered period starts the day you get your money. So if you receive your money on a Wednesday, that's the day you start your covered period. 24 weeks later, it ends on a Tuesday. So that's the way the math works. If it's an 8-week covered period, 8 weeks later, it ends on a Tuesday. If you start on a Wednesday, end on a Tuesday. If you start on a Friday, you end on a Thursday.
Internet access and computer lines, yes, those are included as the covered utility payments.
Does the total incurred allowable usage for PPP money run the entire cover period? Yes, so you can use 24 weeks, not the 8-week period if that's your choice.
Someone has the health and pension can be used for the owner of a C Corp even if more than the 20,000. No, the owner, they're pretty clear about the owners not taking advantage and taking more than that 20,000 cap, so no.
Yeah, and then I need to jump I need to jump here, but the key with that is they didn't want to have happen was the owners taking advantage of the forgiveness for themselves, and so they wanted to go to employees. So that's why they capped the owner at that 2833 and try and limit the forgiveness. They want the employees to benefit.
Yeah, I'll finish up these. So everybody, thank you, Dan.
Okay, thank you, everyone.
I'll just try to zip through the last few here. Somebody asked about a sole proprietor. Again, they say they're an LLC. There are rules for just sole proprietors of an LLC. You have the same max limitations as the others as an owner. And someone else says they have no employees at all. It's just the spouse working for free. Well, the spouse working for free there's not going to be any payroll for that person. So it sounds like the owner is going to take the compensation there. Says the application suggests you can only get reimbursed for 60% of payroll costs. That is whatever you think it suggests. That's not the case. You have to spend the money at least on 60% payroll costs. So again, you could spend up to 100 grand on payroll costs. We don't know the terms yet to obtain the second PPP loan. We'll find out if and when Congress authorizes that. Let me just get through the last here. Dental and vision plan premiums would be includable in the insurance costs. And the benefit of filing before the 24-week period is up. The benefit would be if you think you're going to be having to lay people off in the near future, but you're okay right now, then you would want to file early. That's really the benefit. The downside is, let's say you've laid some people off already, you're removing your ability to rehire them by December 31 this year. And unfortunately, I think we're running out of time here. So let me take one or two more, and then we'll try to answer the rest by emails to people. Sorry. Somebody said, if the PPP loan forgiveness is applied before the 24 weeks is over, can the salaries include the full 24 weeks? Well, no, because you've cut off the period. So no, it's what you've spent during the period. So if you apply at 12 weeks, you're going to include the salaries that you paid during that 12 weeks. Someone said, what form has the mistake on it? There's only two forms right now, but the mistake had to do with the math. They had you multiplying one amount by, dividing an amount by 0.6 when it should have been multiplied by that amount. So, and then finally, is severance pay included in payroll? Yes, from the beginning, severance was allowed and is allowed. So I have a lot of clients who, when they did layoffs, were able to give people a soft cushion and pay them several weeks or months of severance. So that was included. So I'm going to wrap it up now to be respectful of everyone's time. Thank you, everyone, for turning out. Dan had to jump, but we will do our best to get to the rest of the questions and email you. But in the meantime, any other questions, you see Dan and my email address. We look forward to hearing from everyone. Be safe and be well out there. Keep your heads up. Think back where we were in March. I think we're doing well. We're getting through this, and the healthcare community is really, frankly, running at top gear right now. So keep it up, guys, and we're here to help. Thank you, everyone, for your time.